Folks, this is the third of a three-part video series on how to gain an edge in the markets. Today, on this video, we're going to talk about diversification. Diversification is the last free lunch Wall Street will give you, and it's the biggest factor that beginners forget to pay attention to. When it comes to diversification, you see beginners put their head in the sand. Don't do that. You need to diversify your portfolio. That's how you gain a natural edge in the market, and that's what we're going to talk about in this video. Stay tuned. We're going to jump in the lab. I do all my best work in the lab, so I'm going to jump in the lab. You're going to see a computer screen. Don't worry, you'll still see my mug on the side of your screen. See you there. All right, this is the third of a three-part video series on how to gain an edge in the market. And folks, I hope you listen to this. I've got a lot of experience. I started out as a broker. I managed several funds. I've dealt with risk. I've created several systems. These are real basics, and these are things traders say, yeah, I know, and then they ignore. Listen to these things. I'm not charging you anything for this. This is free advice, and it works. What I see happening a lot is this. And again, the first video, just to give you a little recap, first video was about positioning yourself, not swimming against the tide, surfing with the waves in the same direction. That's how you gain an edge. If the market's going south, if the market's crashing, don't go buying stocks. Sell stocks. If the market's healthy, then buy stocks. Now, I'm oversimplifying it right now. I'm obviously making it a lot simpler than it is. If it was that easy, then everyone would be doing it. But I'm just giving you a little taste of the video. You'll get the rest when you watch the video. Now, video number 2, we talked about filtering. How to gain an edge in the markets by filtering. What are filterings? What do you need a filter for? It's not a coffee filter. I'm not selling coffee and I don't drink coffee, but let's talk about filtering. Filtering is how to validate your idea is real when you're trading. How to go beyond just entering a trade. So filtering is adding another condition before taking action. In other words, I want to see the stock go from here to here, and then I'll buy. And I showed you how to use stop orders, not just to most traders. 90% of traders use stop orders as stop loss orders. But believe it or not, you can use stop orders to get in and out of a trade. Okay, so don't get confused. Stop orders can get you in and out of a trade. You can have a resting stop order to get you into a trade. That was the topic of the second video, how to position yourself with filters. And the simplest and one of the most effective filters is a stop order. It'll get you into a trade because it'll show you that the momentum, it'll prove to you the momentum is moving into a stock before getting you into a stock. And I know it's completely counterintuitive, but so are the markets. Now, let's talk about the third video, and this is diversification and correlation. Now, diversification, when I talk to traders about this, I swear to you, this is what causes people to leave the room, start yawning, walk away, go to the restroom, call their loved ones on their cell phones or their girlfriends, whatever. I don't get involved in all of that. So the moral of the story is it's boring. It's not sexy. It's not going to help you make $1 million. But you know what? It'll protect you. I'll talk to people, and here's what'll happen. You'll see somebody trading a stock, let's just say Apple, and they're having such good luck with it, and they're making so much money with it, they say, hey, there's another stock and it trades just like Apple. So we'll start trading 2 stocks. The problem with it, it's a double-edged sword. Volatility, leverage, that's what you're doing. You're leveraging when you're buying 2 same stocks. You can just buy 200 shares of the same stock, but, Anyhow, your profits will be almost twice as high or even more than twice as high, but so will your risk. When anything that goes up comes down, double-edged sword, risk, upside, downside. Keep all that in mind. So I don't want you doing that. And I want to explain to you and show you, because when I say this to people, they say, yeah. And then I ask them, hey, show me your portfolio. And I see 2 stocks that literally are correlated. So folks, I'm going to explain it to you once and for all. The only free lunch Wall Street will give you, not the only, one of the very few free lunches Wall Street will give you is the ability to diversify. You don't want to put all your eggs in one basket. Never, ever you ever want to put all your eggs in one basket because you don't really know what's going to happen. We're basing everything on odds. When you go to Las Vegas and you gamble, you take your whoever and you go to Las Vegas and you gamble. You don't put all of your life savings on the poker table, right? You diversify. No. The bottom line is, and I'm not advocating going to Las Vegas. I'm just using that as an analogy. The point I'm trying to make is I want to show you correlation between some stocks so you don't do this. This is United Airlines. See, it went up, it goes down, it goes up, it goes down, then it goes up again. And I'm trying to be funny, but not trying. But the point is, notice this chart. I'm going to switch to this chart. It's not identical. I'm just going to go back and forth, back and forth. One is American Airlines, one is United Airlines, back and forth. Now, again, they're not exact, but are you starting to, you seeing what I'm seeing here? They're really close. Now, look at Coca-Cola. See that double top here with a rounding coming down, breaking the low? Look at, this is Pepsi. It's breaking the low. One is higher than the other. See, noticing a pattern here? Again, United Airline, American Airline. United Airline, American Airline. Coca-Cola, Pepsi-Cola. That's called correlation. You can't get away from it. Now, you could trade stocks that aren't, this is obviously done as an example, and not all stocks are this correlated. But honestly, I want you to start introducing assets that are inverse correlated to the market, like this asset here, TLT. It's a bond ETF, so you don't have to know anything about commodities or futures. You don't have to go to a brokerage, different broker. You could trade this anywhere you trade stocks. This follows the 10, 20, 30-year bond. Anything over 10 years in terms of bonds, their correlation is 99%. So 10-year, 20-year, 30-year, I just called it the long bond. I think they call it the 20-year plus bond. But honestly, anything above or beyond 10 years, you'll get the same type of movement, give or take. So notice this. This tends to move inverse to the stock market, especially when the stock market starts moving south. So whenever you see a stock market moving south really sharply, you'll see the bond market spike. That's one asset. TLT is the ticker symbol. GLD, gold, another symbol. They're not doing much right now because the stock market's not doing much right now. But boy, oh boy, wait till the stock market starts moving. You're going to see movement in gold and in bonds. So again, don't put yourself in a situation where you have two stocks that are following each other, like Coca-Cola and I had Pepsi there, but it's gone now. Anyway, here we go. Yeah, I mean, look at this. Look at these two stocks. That's Coke, that's Pepsi. You're not going to win either way. I mean, just stick to one. So here's some tips for you. The S&P 500 is divided into 10 major sectors. I know. Some will tell you it's 11 sectors with this new information technology, but no, it's 10 sectors. Because information technology is technology, information, and telecommunication. It's all technology. 10 major sectors are the S&P. Try to trade sectors that are totally uncorrelated. For example, utilities and technology, consumer discretionary and consumer staples, energies and real estate, sectors that don't have a common thread. And then try to diversify by including the long bond and gold in your portfolio. It will always give you a natural hedge. If you look or talk to most hedge funds, multi-billion-dollar hedge funds who've been doing this for decades, they'll tell you gold and bonds make up a large percentage of their portfolio at times. And usually, even when the market is really bullish, they'll have a little smidget of gold or bonds or both in their account. All right. That concludes our 3-part video series on how to gain an edge in the markets. I hope you guys enjoyed it. I love being here with you. I want to hear your comments, and I'll talk to you guys soon. Again, if you're getting something out of this video, ring the bell, subscribe to this channel, and like this video. And if you want to reach out to me, Roger@wealthpress.com. I hope you're enjoying this channel. Talk soon.